The 30-year Treasury bond might be the most unexciting investment in existence. You lend money to the United States government, and 3 decades later, after paying off a mortgage, a couple of cars, maybe your children's college tuition, they return your principal with interest. No one brings it up at dinner. No one brags about it at work. Its changes are measured in tiny increments. Wall Street analysts describe it in ways that could make a statue fall asleep. Right now, that dull figure is signaling something the bond market has mentioned only a few times in modern financial history. The yield on the 30-year Treasury has just surpassed 5.1%. That is not an error. For anyone with savings, a retirement account, or an ongoing mortgage, this number is far more relevant than the S&P 500 reaching another record high. Most stock market observers celebrating new peaks have no clue what this bond number signifies. This is what I aim to clarify. The people who grasp this ahead of time make very different choices than everyone else, and the consequences of those decisions can be substantial. So, what is a Treasury yield in plain terms? It is simple. When you deposit money in a bank, the bank pays you interest. When you lend money to the federal government by purchasing a Treasury bond, the government pays interest. That rate is the yield. For most of the past 20 years, the 30-year yield remained comfortably below 5%. Low inflation, accommodative Federal Reserve policy, and global trust in U.S. government debt kept it anchored there. 5% is not random. Financial historians repeatedly point out that this is the level at which long-term borrowing costs start to significantly influence the real economy. When the government's borrowing costs reach this point, everything else becomes pricier. Mortgages follow this rate. Corporate bonds follow it. Student loans, infrastructure projects, municipal debts for roads and schools all grow more expensive when the 30-year yield crosses 5%. Some analysts call this the line that, once crossed, changes the arithmetic of risk across the system. Every major bond market downturn in modern history, the period before the 2007 to 2008 financial crisis, the early 2000 tech collapse, and the Japanese asset bubble of the 1980s, featured long-term government yields moving past a threshold like this one. Not because the yield caused the crisis, but because it reflected what smarter long-term capital already anticipated, a structural shift. You might respond that the stock market is near all-time highs, corporate earnings remain strong, and the U.S. economy is still growing. If anything were seriously wrong, wouldn't stocks show it first? That is a fair observation. And it is exactly why this moment is notable. What we see now is an unusual divergence within the financial system. The stock market, especially large-cap technology and artificial intelligence companies, is valuing a future of continued growth. The bond market, on the other hand, is valuing a world where inflation remains high, borrowing costs stay elevated, and the Federal Reserve cannot reduce rates anytime soon. One of these is wrong. Historically, the bond market has been a more accurate predictor of economic conditions than stocks. Equity investors tend to be optimistic and momentum-driven. Bonds are dominated by institutions whose entire business depends on correctly forecasting inflation and interest rates over years, not months. The current gap between what stocks suggest and what bonds indicate is by many measures the widest in decades. These divergences do not persist indefinitely. They eventually converge. The key question is which side adjusts toward the other. To put numbers on this, as of May 2026, the annual U.S. inflation rate is 3.8%. That is the highest reading since May 2023 and marks the 4th consecutive month of acceleration. The previous reading was 3.3% in March, and before that, it was 2.4% in January. This is not a plateau, it is a trend moving in the wrong direction. Energy costs are the primary driver. Over the past 12 months, energy prices increased by 17.9%, the steepest annual jump since September 2022. Gasoline alone is up 28.4% year over year. If you commute, heat your home with fuel oil, or buy groceries transported by truck, you're already experiencing this impact. Real average hourly wages fell by 0.3% annually in April. Inflation is outpacing paychecks. The Federal Reserve's target is 2%. We are at 3.8%. The core inflation rate, which excludes food and energy to measure underlying price pressure, is at 2.8%, and it accelerated in the most recent reading. Futures traders have now ruled out any possibility of rate cuts through the end of 2027. Some are even considering rate hikes. Here is why the stock market situation is precarious. The top 10 companies in the S&P 500 now account for roughly 35 to 40% of the entire index by market capitalization. That is unusual. In 1990, the 10 largest companies held about 19% of the index. At the peak of the dot-com bubble in 2000, before a 50% market decline, they held about 27%. Today, that number nearly doubles the dot-com peak. The companies driving this concentration are almost entirely tied to a single investment theme: artificial intelligence. During the most recent 28 session rally, analysts at a major investment, Bay, These are very different dynamics, and rising interest rates have historically been one of the most reliable forces for compressing valuations of high-growth technology companies that rely on cheap capital to support future earnings projections. The mechanics are straightforward. A technology company whose valuation depends on earnings projected 10 or 15 years ahead is extremely sensitive to the discount rate applied to those future earnings. When the 30-year yield rises from 3% to 5%, the present value of a dollar earned in 2035 drops significantly. Multiply that across hundreds of billions in projected artificial intelligence revenues, and the current valuations become harder to justify. This is not speculation, it is arithmetic. This information should not make you panic, sell everything, or move entirely into cash. That almost never works, and usually locks in losses at the worst moment. Instead, it should help you become a more informed participant in your financial life. Those who navigate difficult markets successfully are rarely the ones who guessed the exact timing of a decline. They are the ones who understood their exposure, made deliberate adjustments, and avoided decisions under emotional pressure. Consider a grounded, practical perspective on finance, understanding the mechanisms behind news events rather than just reacting with fear or hype. A few actions are worth considering. First, review what you own. If your retirement account is in a standard SP 500 index fund, recognize that you have significant exposure to the artificial intelligence and technology thesis. That is not automatically a problem, but it should be a conscious decision, not an accident. Second, consider how interest rates affect your personal finances. If you plan to refinance a mortgage, buy a car, or take on major debt in the next 1 to 3 years, 5% long-term yields have already changed the calculations. Third, watch the gap between stock prices and bond market signals about the economy. That gap rarely closes gently. The bond market has been signaling for months. The 30-year yield at 5.1%, inflation accelerating toward 4%, real wages falling, and the Federal Reserve unable to cut rates are not isolated data points. They form a coherent picture of an economy where the era of cheap money that inflated asset prices for over a decade is genuinely over. Adjustments are necessary. We may be at the start of that adjustment, or the stock market may hold resilience for a few more months. Nobody knows exactly, but the information is there for those willing to look. Please leave your thoughts about this content in the comments below. Thanks for watching. See you in the next one.